The Road to Autonomy is presented by the Road to Autonomy Index. The Road to Autonomy Index is a rules-based equity benchmark index that measures the performance of a basket of global companies that are involved in the development and commercialization of autonomy. Institutional investors and fund managers are watching megatrends that are shaping investment opportunities today. These megatrends are creating thematic investment ideas and opportunities for forward-thinking investors. We believe that one of the biggest megatrends today is autonomy. That's why we created the Road to Autonomy Index, the world's first and only pure-play index to track the thematic investment opportunity in autonomy. Follow the Road to Autonomy Index on your favorite finance app by simply typing in the ticker Autonomy. To learn more about the Road to Autonomy Index, visit roadtoautonomy.com/index. Hello and welcome to the Road to Autonomy. I'm your host, Grayson Brulte. On today's episode, we're absolutely honored to welcome Dean Foreman, Chief Economist, Texas Oil and Gas Association. Dean, welcome back. It's the third time you're on here, and every time you're on here, the conversation gets more and more interesting. So I'm really looking forward to today's conversation.
Thanks so much, Grayson. It's great to be here. Great to join you again.
Dean, there's a consistency with you that I love. You offer incredibly great insights into the oil market. Some of the best insights I've ever read have been published by you, and you offer really great commentary into those insights. Kicking this off, Dean, what is the current state of the oil markets?
Well, in a nutshell, they're deceptively tighter than relatively modest prices of plus or minus around $70 per barrel recently would indicate. And the reason for this really is if we go back over a year and a half, the increased interest rates by the Federal Reserve that have been followed by central banks around the world have forced market participants to really factor in the prospects of, well, lower spending, higher costs, lower economic growth across the board. That's had a big downdraft. Every time it looks like tight market fundamentals for oil, OPEC's supply reductions have bumped prices up. The interest rates have bumped them back down with economic uncertainties in financial markets in reaction. We're at an interesting juncture because the economy has continued to muddle through. The job report, this last week was pretty solid for the U.S. The global projections for oil demand are to record amounts, to record levels, 102.7 million barrels per day next year per the U.S. Energy Information Administration, a record high, at the same time as OPEC has also cut supply. And these modest prices have scared off some drilling activity. So we've actually seen some of that slow across the United States. And it raises a question of where the supply is going to come from and whether markets really see exactly what's there. Where these things come together traditionally is looking at inventories as a summary statistic. And now for total commercial and strategic petroleum reserves in the U.S., as of the report from EIA yesterday, we're sitting at the lowest point since January 1986. So historically low inventories, where both the commercial and the SPR side has come down, suggests that the supply pressures might continue to mount if the economy stays on track here.
With supply pressures potentially mounting, if you look at the data around spending, a lot of the consumer spending is driven by experiences. It's a lot of less hard goods, more towards experiences. And if you want to experience something, a lot of that has to do with travel. You're either in a vehicle, you're on a plane, you're on a cruise ship. It's all about an experience. So if we have historically low inventories, then consumers are shifting towards experiences. What happens there? Do we have to find more oil to these consumers can have these experiences? Because as I said, a lot of it has to do with mobility and travel.
It's an entire value chain. Keep in mind, it's not just having the oil, but it's getting it into the forms that are needed. So if you have a rapid increase, for example, in air travel, that coming back, and especially during the summer season, we're seeing that where we've recently 1.7 million barrels per day in the U.S. of demand. This is almost back to pre-pandemic levels in terms of the growth back in air travel, air fuel demand, jet fuel demand. That tells us that you've got to have the supply chain that anticipates the need for that fuel, how much and where it needs to be, and have the supply chain in action to actually get it there. Last summer, there were more concerns about that in the wake of the pandemic, and especially for jet fuel, of getting it to airports where it was needed. It seems to, from that perspective, have worked really well this year. But again, across the board in terms of driving, we've seen for the same week gasoline demand up more than 3% compared to where it was a year ago. Air travel activity definitely up. If you're right, and it's more about experiences and less about goods. That explains flatness in terms of diesel demand, but still solid. And then industrial demand for petrochemicals, liquid fuels through the value chain, all of that has continued to remain pretty solid. So the numbers, if we're looking at total U.S. petroleum demand this last week of over 21 million barrels per day, 21.2 is the exact number from the EIA, that's phenomenal to have come back, to have, and keep in mind, this was the point in the year where the consensus expectations were for stall speed in the economy. This is where you would see the weakest point of growth in the wake of all the pent-up effects of the interest rate increases that we've talked about and seen over the last year. $70 a barrel in a recession, tight markets in a recession. Is this really a recession? That's the question. So how far? And the financial market's negative reaction actually to the positive jobs report this last week shows that natural tension between, is it really good news, or is it good news bringing bad news because it means more rate increases and less affordability going forward?
The affordability is a big concern. If you look at consumer spending, I started looking at charge write-offs. The Apple card, backed by Goldman Sachs, is a 2.12% charge-off. Astronomically high. There's reports in the Financial Times, I'll source it to them, that Goldman is trying to unload their business because of the amount of losses to the consumer. And then you look at data from Capital One, you look at data from Bank of America, data from JP Morgan, the amount of debt consumers are carrying on their credit cards is increasing at a rapid number, and it's very scary. If the Fed keeps raising interest rates, the consumer, the money that they have to pay to service a debt only goes up, and they're never going to get out of debt. That becomes a big concern. And I look into this, and the Fed, Mohamed El-Arrouzi was on Bloomberg today talking about how the Fed is so data dependent, and that's why you're seeing these seesaws on the Fed. Does the Fed have to pivot away from being so data dependent to looking at what's happening in the real economy? I'm asking that because there's all these talks, well, do we get a soft landing? Do we get a hard landing? What impacts will these landings have on the oil markets? If these consumers are sitting with this much debt, they're going to stop spending on experiences because they're going to have to service the debt. If they don't service the debt, they're going to have to charge the car companies have to charge it off, and then we've got a pretty nasty recession. We could look in the 80s.
So a couple of perspectives here, and it's both about the level of the interest rates, the amount they've changed in a short period, which is actually unprecedented, and then separating out a consumer impact from a corporate or industrial impact. On the consumer side, you're right, the numbers are high. They've gone up, and some of the delinquencies have also risen. If we look at the New York Federal Reserve, they put out a consumer credit report, and they track a lot of these things. And while the delinquencies have risen, it's not at historic highs. It's not at recessionary levels. So that is one point that's a silver lining to all of this. It doesn't mean from an individual household standpoint that seeing the interest rates go up the way they have is anything less than concerning, right? If you're carrying a balance, credit card debt has become a source of potential unaffordability and a stress point. Having some sink in the system, it does mean that through financial literacy, having people realize that if they can't afford to carry that debt, that they have to find ways to either refinance it, get rid of it, manage it going forward so that you can. That's a natural tension. Now, corporate rates have also risen, and we've seen high yield for those that have less than investment grade credit go up to eclipsing 14%. This is interesting in that the difference between the risk-free rate, the Fed funds rate, and that high yield or lack of investment grade credit rating, that difference has actually narrowed in the recent months. It's come down to less than 9%. Now, historically, that's not a huge difference, at least in terms of the span of credit quality. And it says that things are normalizing. So in the wake of the pandemic, concerns about lower credit quality companies going bankrupt meant there was a huge premium to be paid for not having investment grade, and your biggest, safest corporations outperformed as a result of that. This really separated where quality mattered. And what we're seeing is that it's another silver lining because it says some things have normalized. But even though rates are higher, your penalty, if you will, for not having investment grade credit has, in a relative sense, decreased, which increases the potential for these companies to continue to survive through the downturn. And again, if this is the point at which there was supposed to be a recession, we haven't seen as many bankruptcies as you would expect to see during a typical recession. So this has been, again, a couple of sources of strength there.
There's definitely strength in the economy. Everybody that's listening to this can agree to that. What we've seen, though, the unfortunate non-strength is the companies that went public through SPACs that shouldn't have gone public because they didn't have the balance sheets, they didn't have the revenue. And that's being, in my term, that's being flushed out, and that's very healthy for the markets. While the stable, let's call them the single A, the double A, and then the very rare triple A credit rated companies, they're doing fine. They're still making revenue, and they have very strong balance sheets, and they could weather the storm, or you can use the Jamie Dimon term, the hurricane coming offshore. They'll be able to weather that. Historically, how have oil markets performed in a rising rate environment? I'm asking this with the backdrop of a U.S. Treasury currently trading at 5.12%, the Fed making overtures that they are going to continue to raise interest rates based on the latest minutes. How have the oil markets performed in this environment?
The knee-jerk reaction is what we talked about. Of normally, if you're raising interest rates and you're doing that to kind of slow things down, and the Fed has been trying to slow demand in this process. Market participants factor that in. They expect slower growth, and that's usually downward pressure on not just oil, but the broader commodity complex in the process. What we've seen this time, though, is that with the fundamentals we talked about earlier, the strong demand, the supply challenges, OPEC's role, and actually Russia's role as a supplier, which has been pretty crafty, actually, in continuing to place oil on the market, less successful on the natural gas side, but still affects, and there's some substitution, especially in Asia, between the two. It affects the broader commodity complex in important ways. So we've seen modest but still solid prices through this point of economic softness, and that's important. That tells us that the market fundamentals ultimately will trump and continue to matter to the balance, regardless of what happens on the monetary policy side. We're going to go through these steps, and the Fed's going to be data dependent. Per your earlier question of will they need to become less data dependent? I think for their own credibility, they need to maintain that data dependence. You can't have the Janet Yellen headline from 2 years ago of "I was wrong about inflation," right? It has to be something where they're credible, they follow through. That's the only way they reestablish that credibility and continue to have markets believe in a self-fulfilling expectation of what inflation can actually be here. If people are going to plan forward, that's important. Now, where they have issues are the inverted yield curve. So when you've got longer-term rates below short-term rates, that produces some perverse incentives for investment and consumption. And we need to see how that normalizes and plays out. Some of the things that we're talking about, how fast this has gone relative to just sorting out over time, these things can be corrected, and we'd expect some policy correction if the economy ends up really hitting stall speed. But so far, they've kept their foot on the accelerator because they've seen the signs of underlying strength and resilience.
If they keep going the way they're going, this is my personal opinion, they keep raising the way they're raising, something's going to break. We saw what happened with Silicon Valley Bank. That was a pretty big break. There will be other breaks. There's historical data to look back at those breaks. When you raise rates in this fast, things break. You mentioned that Russia's getting oil onto the market. I'm going to go back in the history way back machine. Is that very similar to the Mark Rich Iran days where they were painting the back of ships and moving oil? It was very well documented in Javier Blas's incredible book on the oil markets. Is that similar how they're doing it?
Pretty much, and Javier actually has some great statistics on showing Malaysian exports of oil to China, and I guess his latest stat was that Malaysia was sending to China roughly 3 times the amount of oil that they're capable of producing. A lot of this is Russian barrels that are finding their ways furtively through markets. Kepler and others have been showing where offshore markets have, in Europe, the Mediterranean, Asia, have popped up where ships get offloaded, things continue to move. And keep in mind that both oil and petroleum fuels made from it are relatively fungible. So yes, there's some quality differences, but net, their production in Russia is relatively self-sufficient from international oil services. They've continued to see their costs go down as the ruble is depreciated. And they found ways to find markets, even though it's been a pretty massive market shift, and they've had to compete against their partners in OPEC and OPEC Plus, Saudi Arabia in particular, in competing to place those barrels into Asian markets. So it's been quite a balancing act, and they've, even despite the G7 price cap proposal to try to cap the revenues that Russia could earn off of its barrels. That hasn't been altogether successful either. And part of that is that the prices have remained in a band where a lot of the Russian grades of crude oil haven't actually been impacted materially by it. If prices rise, if markets continue to tighten, and if the Fed goes to neutral, one of the uncertainties there is how binding is that? And we started to see a few months ago where at the point at which it looked like it could bind, Japan actually kind of bailed on that price cap proposal and said, nope, we're going to continue to buy Russian oil. The world's wherewithal to stick with its policy and its beliefs over the fundamental economics of making sure that your constituents, your citizens, have energy at affordable rates when they need it. Yeah, that's the underlying thing that seems to dominate here. So natural gas is different because it's not as fungible. It's very much a regional and seasonal market around the world. And we're blessed in the United States to have really ample supply and strong storage at this point. We're exporting about as much as we can. Despite record high exports recently of natural gas from the United States, we still have prices that are sitting a little over $2.60 per million BTU, which is historically quite low. This is the benefit of the energy revolution at home, of having oil and gas supplies, having these things remain modest despite everything that's happening in the world.
Where are we exporting the natural gas to? Is it to the developing world, emerging markets, or where is that natural gas that the United States is exporting going?
Up until Russia's war in Ukraine escalated, majority, 60-70% of that was going to developing Asia. And then maybe 20% or so, 20 to 30 going to Europe and other countries. That's flipped on its head in the last year, and it's continued this year where over 70% is going to Europe because, again, with Russia's war in Ukraine, the loss of Nord Stream 1 and 2 pipelines, you just don't have the natural gas supplies that we're going through pipeline that can make it to another market. To the extent they're producing LNG and shipping that internationally, that's still going. But the vast majority of Europe has lost about a third of its supply as a result of this and has tried to buy up the cargoes that exist of liquefied natural gas. Many of those were actually owned or slated for China, and China's been rather clever in reselling those cargoes, redirecting them to Europe, which has been willing to pay more. But then China had a combination of both slower economic growth that lowered their demand for natural gas and the ability with a lot of domestic coal production to shift to rely increasingly more on coal vis-a-vis gas over the last year. And one of the questions that's really critical over the latter half of this year is if China really is coming back as people expect, and it's not that it's zoomed back, it's not linear, but they're pumping a lot of liquidity to pump up their real estate markets, construction, to go back to the playbook of, in depreciating their currency recently, they're trying to spur export-led growth. So a lot of production of the things that we all want and need. Well, all of that takes energy, especially oil and natural gas. And if they aren't willing to send those cargoes or redirect those same natural gas cargoes to Europe to the same extent they did last year, and if we've returned to any semblance of normal seasonality, not an abnormally warm winter like Europe had last year, then we have challenges. And this is where, again, the historically low natural gas prices, $2.60 per million BTU today that we're looking at, become a bit of a puzzle in trying to piece together the global picture.
China has been very public on wanting to own and control the battery market for electric vehicles. Now they're trying to control the semiconductor market. They want to export. I repeat, they want to export around the globe. Where they're going to be able to export, I'm not going to give an opinion or a comment on that, but they clearly want to do that. And you're right, they are trying to prop up their domestic real estate business. But the more I start looking into the China and the geopolitics, I started noticing that China took Putin back on the stage. They did a geo-national meeting with India. Russia with Putin was there, and a lot of the APAC regions. So you have India and China, two of the largest markets. They're welcoming Russia in there. That gets really, really interesting and very, let's call it politically complicated. Is China trying to control Asia and basically cut off? They said, we're going to control our own supply chain. We're going to control our own destiny?
It's a balancing act. They're continuing to grow into a more developed nation and economy. And with that growth comes the responsibility, the influence, and the ability to more strategically control certain markets and technologies. It's not just semiconductors, whether it's rare earth minerals for wind turbines, whether it's the manufacturing of solar panels. You've seen over the last year more concerted efforts to not just control the value chain that goes with it, but the intellectual property that goes with it. And this is one of the questions I think is really interesting for an energy transition, is we just sort of assume that new technology comes and it proliferates or diffuses around the world in a pretty seamless way. But when you have large national players that put up strategic barriers to the spread or diffusion of that technology in a cost-effective way, then you have other issues. The balancing act that they're striking with Russia, with Vladimir Putin in particular, is one of increasing reliance. They've been getting a deal on oil. They continue to get natural gas and want to build more pipelines going to China, as that's a growth and demand source. Developing Asia, especially China and India, have been the markets that many energy producers have really wanted to serve. They pay a premium for it at times. With the growth, both in materials and transportation, it's a source of enduring demand. So if you expect an energy transition that ultimately over a course of decades could lower demand, think of it as the kind of structural change that we've seen in many other markets. The one who has the customer at the end of the day is the one who survives and wins. So having that strategic partnership with China is important from a Russian perspective. It's important from a Middle East perspective. And from China's perspective, it's being able to leverage one against the other, to have competition to supply them, and to have strategic partnerships and a diversity of supply is really important for their energy security and their economic security. There are a lot of elements at play here, but that's roughly how I see the things that you've asked about fitting together.
Well, let's dive into the oil aspect of this, because there are forecasts of oil hitting a record high in terms of global demand in 2024 at a record of 102.7 million barrels per day.
Yeah.
That's a lot. What's driving this demand? Is it China? Is it India? Is it the developing markets? Or where's this demand coming from?
Well, it is primarily emerging markets that are driving this. And that's a different pattern than what we saw in the immediate recovery from the pandemic. So after 2020 and 2021, you had a lot of advanced economies coming back into play, producing things, a lot of transportation, and that was leading oil demand growth globally. But now, as that patterns matured, we're seeing emerging markets drive the majority of economic growth this year, projected again over the next 2 years, and hand in hand with that has come the energy demand to go with it.
Okay, so let's fast forward into 2024, and I'm not making a prediction, but there's a 50-50 chance that the global economy goes into a recession. We saw some data from the Bank of England there, potentially there. We're seeing data from various analysts and forecasts here in the United States that the global economy could go into recession. If the global economy does go into recession, does the demand for oil continue? Does it plateau? Does it decrease? Where does that demand fall?
It's a great question. I think from a listener's perspective, just unpacking this a second, of when we think of an individual country and what a recession is, we think of an economy that contracts in consecutive quarters, an NBER, National Bureau of Economic Research kind of definition. But on a global basis, it's really the exception, not the norm, where we see the economy contract as it did in 2009 and then 2020. Normally, slow economic growth, where some economies do well and others don't. If the global economy grows like it is this year, projected around 1.8% on a market exchange rate basis, that's a global recession. So we're seeing economies in Europe that are suffering, right? We're seeing others around the world that are going through some of the stresses with the big change in interest rates, commodity prices for what they're selling, what they're having to buy, their terms of trade degraded. All of these have led to pressures, but net, even 1.8% growth is still leading to official expectations of more than what you would expect as proportionate oil demand growth this year. So over 1.5 million barrels per day by official estimates. Normally, in a normal year, you'd expect kind of a 2-to-1 ratio on that. And you'd say divide by 2. So if I think the economy is going to grow by 1.8%, I would expect global demand to grow by 900,000 barrels per day, 0.9. Going into next year, it's kind of that ratio, but it's still a rebound to 2.5 to 3% growth in terms of world growth is what's expected. So not a big downturn. This, again, is the soft point that is broadly expected by the economic community. And in tandem with that, the official expectations are for growth again of close to 1.5 million barrels per day next year. So if that plays out, you have to have the supply come from somewhere. And so far, if drilling activity is pulling back, if OPEC doesn't want to open its spigots back up, these are where the challenges have historically come from. And that's the thing that, from a market perspective, we really need to watch.
Can the United States bring more supply online?
It can. And it will, and it's expected to by official estimates. The question is how much and how fast. So Texas is basically 5.4 million barrels per day of oil production, close or at record levels. In March, it set a record. It's pulled back a little bit, but this is phenomenal. The Permian Basin, also on the New Mexico side, not just the Texas side, has performed really well, and New Mexico has the highest oil production that it's ever had. But when we look broadly across the U.S. and the other oil-producing states, whether it's North Dakota or Wyoming or Colorado or even Oklahoma, we're not back to pre-pandemic drilling levels, and the production really just hasn't zoomed back the way it has in Texas and New Mexico. So that's a challenge. The maturation of the energy revolution, just the natural process, is part of this. State politics, federal leasing issues, energy policy, infrastructure, all of these are affecting the pace and the ability to invest in oil and natural gas developments across the country.
I'm not an economist. I love economists. I'm gonna put my economist hat on here for a minute, because Texas economy has led the nation's growth for the most two recent quarters, growing at an annual pace of 7.6%. Repeat, annual pace of 7.6%, or more than 2.5 times the U.S. average. And you mentioned that Texas is record high oil production at 5.4 million barrels per day. Texas is making money. It's having a positive impact on its economy. Why don't more states pay attention to, if you want to call it, the oil economy in Texas, and look at all the jobs it's creating, look at the positive economic benefit it's having on the state as a whole, not to mention all the Californians and individuals moving to Texas. That's having a very big positivity on the state. But the oil market, it seems like it's really moving the state in a very positive, healthy economic direction.
It's kind of like the slogan on my license plate, Grayson, that says, Texas, it's like a whole other country, because look, Louisiana, Texas, New Mexico, they're doing their part, they're stepping up, but they're also relatively self-reliant and relatively friendly business environments to build infrastructure and invest through the entire value chain. If you're a major natural gas producer sitting in Ohio or Pennsylvania or West Virginia, you can look no further than the Mountain Valley Pipeline issue. As part of the Deficit Reduction Act was recently resolved, but you had a pipeline that was 95% built that couldn't be completed, and you had market very noticeable from the Carolinas through Virginia premiums on a calendar basis for this year that were $2 per million BTU higher. We're talking $2.60 per million BTU at Henry Hub. You had premiums coming into this year that were that again, just because they couldn't get the supply going down from the Appalachian region into the Southeast, which historically has never been a major issue, but that's where a lot of the gas demand growth has come from. New York and New England are famous for having infrastructure bottlenecks. It's really New York that prevents New Englanders from being able to get it. But again, not being able to move things becomes an issue. And even if you take that now to North Dakota, they're still reliant on a lot of interstate pipeline infrastructure and expansions of it to be able to invest and grow. So it's one thing if you're investing to offset natural declines and you've got infrastructure in place to take advantage of it. It's something different if you need to expand either for domestic processing or for exports. The Gulf Coast is very well situated for that, and that's why you're seeing that. It's a bit curious that Oklahoma has suffered. So Oklahoma is historically more of a gas than an oil producing state, but their drilling activity is down over 20% from pre-pandemic levels. And it's curious because that is a relatively good state in which to do business. It's, again, another inside baseball thing for the industry to watch. Colorado has a fundamental shift in state policies. They really, in an economy that's relatively affluent and diverse, they want to continue to go a more California-like direction, so it appears. So the policies really don't incentivize a lot of investment in drilling there. Wyoming, the federal leasing issue has had a big impact there. I think the Inflation Reduction Act and some of the things around low carbon businesses growing will be important both for Texas and Wyoming. But we need to see how these things play out because there are pluses and minuses along the way. And right now it just isn't physically capable or financially capable of zooming back the way it did earlier in the shale revolution.
I'm a business owner, but I'm not a politician. If I was a politician, and as I know this from a business owner, you want to have a diversified income revenue stream. You do not want to rely on one source of income. And if you're a politician, you can't just rely on tax revenue. You have to have multiple companies, multiple diverse industries that are going to support a healthy economy. Every state has its own economy. And if you look at, let's go back to Texas again, because from January 2023 to April 2023, Texas generated $73.2 billion of state export revenues. That's a healthy economy. Go Governor Abbott on that one. Well, let's talk about this revenue. Where is it being generated, and how is it projected to grow leading up to the global record oil demand that we projected in 2024?
Well, I guess a couple of points. First, the Texas economy, as we've talked about, has been leading, at least in my own analysis, when you look at its relationship to the broader U.S. economy. When Texas does well, the U.S. does well. So that's point one. When we look at the benefits of exports in particular, you'd think, given the conversation we just had about record natural gas exports and how much of that's coming from the Gulf Coast, that maybe that would be the biggest source. But it really has been, since 2016, lifting of the U.S. historic ban on exporting crude oil, natural gas liquids, refined products made from crude oil. Those have been the things that have been driving the majority of this. So natural gas is important, but in context, it's really the liquids that have been driving a lot of the Texas activity and value that's been coming from that.
How intertwined is Texas' economy with the global oil markets? Texas seems like it's its own oil economy into itself, but how intertwined is it with the global markets?
Oil prices still have quite an impact on Texas' economy, certainly in terms of the activity levels for the industry. Now, Texas over time has diversified its economy. It certainly has other things. But if you tie it together in the entire petroleum value chain, more than many other economies, the thing that really stands out for Texas is the size of its industrial base. So the industrial share, both in its economic contribution, but the amount of energy it uses is tremendous. So when you have cost-effective energy produced in Texas, not only is it fueling Texas exports and Texas activity, but an entire manufacturing value chain is energized then, and that leads to more domestic production of goods, more exports, and it feeds on itself. So the so-called multiplier effect is huge for that, and that's why when we separate out whether it's warehousing and transportation, pipelines, petrochemicals, manufacturing made downstream from each of those things, it accounts for more than 40% of the Texas economy when we start looking at all the things that are energy intensive. And that punches well above its weight when we start looking, okay, it's not just the extraction of oil and gas, it's everything made from it. And then the thing that's subtle but increasingly apparent in recent years, one of the data products that I'm working on for Texoga, by the way, is a petroleum value chain that separates out. You would think for Texas, if you want to know exactly how much was coming in and how much was going out and how much was made, that you could know that to the month or the day. Good luck trying to find it. It doesn't exist. You have to really piece a complicated puzzle together to get that. And we're starting to produce estimates of this that show how important Texas is in taking the crude oil that we mentioned New Mexico at record level in its production. New Mexico can't do anything with that oil otherwise. It doesn't have additional refineries in state to take advantage of it or additional market. It's Texas that, through pipelines, is taking that, processing that, exporting that. And it's the same for the volumes that are being produced to some extent in Colorado, in Oklahoma, and other states. It really is important as a conduit for an energy center for the United States and the world of producing growth off of its geographic location, its concentration of infrastructure, all the investment through the entire value chain.
I like it. I'm looking forward to having you back on to talk about your petroleum value chain report, because I want to be really curious of the indirect jobs that the industry creates. It has to be in the millions, I would imagine, in Texas that this industry creates.
I don't have the exact number off the top of my head. Nationwide, the industry might have a couple million people directly employed, but when we look at support through the entire value chain, it's close to 11 million. So it does make a huge difference when you look at the entire amount of jobs and services that are supported by the industry's growth. And for Texas as a whole, what we've seen is that it's a diversified economy, but oil and gas are integrally important with it. And as it's continued to grow, the investment that's coming through the value chain is also going in tandem with it. It's regionally diverse within Texas. It's not just one place. We see the places that are inland in EIA's data are continuing to be advantaged by the things that are produced locally. The Gulf Coast locations are increasingly world-scale ports, infrastructure, pipes, the ability to take advantage of these new and growing global markets. And it's that key because there's no other place in the U.S. where you're going to see this, right? It is a nexus. When you're talking about the relationship to the global economy, I don't think if the global economy sneezes that Texas necessarily catches a cold, so to speak, but it is a really important contributor of cost-effective U.S. homegrown energy to global markets as a result of its geography, its infrastructure, and its resources.
What percentage of U.S. oil originates in Texas?
Well, for oil production as a whole, I know the number is like 27% for gas. For oil, the current number should be a little over 40, so 43.6% is your exact number. It's over half of the drilling, by the way. And this is important because these numbers have risen in recent years where it's, from a production standpoint, it used to be in 2018 that just over 40% of the oil in the U.S. was produced in Texas, and now you're up at 43.6. So every year it's ticked up just a little bit, and that tells you that its importance in terms of being critical to the market, the other states dropping off to some extent in terms of activity relative to pre-pandemic levels that we talked about. Texas is important, and that raises the stakes, by the way, on the policy side, because it means you have to have predictable, good investment environments in the infrastructure to enable all of this. Whether we're talking at a Port of Houston, Corpus Christi, you need to continue to, through the entire value chain, see policies that want to incentivize those activities.
You do have to see the policies that want to incentivize it because the right policies create jobs. The oil and gas industry creates jobs. That's the bottom line, and it supports millions of individuals directly and indirectly in the United States. We're in hurricane season now. I am in Florida, the industry we're talking about in Texas, and Texas can get hit by hurricanes, and we can too. Is there a playbook or a game plan that the Texas oil and gas industry puts in place? Okay, June 1st hits. We're in hurricane season. Okay, have X, Y, and Z ready. Is there a game plan that the industry puts in place in case the unfortunate happens and a hurricane does take out a refinery or does go up through the Gulf into Texas?
These are important issues, and the industry works together with state and federal government, local government to make sure that, well, first, things are getting where they need to be and that people are safe in the process. If there are regulatory waivers that need to be secured to make sure that things get to where they need to get, the communication really ramps up a lot during hurricane season. You have regular meetings, and then as a hurricane approaches, you have teams that cut across, again, industry, state, federal government, really working together to make sure that the entire value chain remains operational. And at the time that there's a hurricane that lands, the supply chain response of being able to get things where it needs to go is unprecedented. It really is almost like military precision, and the industry works together with government to make sure these things happen in an orderly manner.
Is there any impact if a refinery goes out of there or there is significant damage on the global oil markets, or the global oil markets significant enough to withstand that short-term outage?
Well, we'll see how things play out if those kind of events coincide with losses of Russian or other supplies, right? But historically, you can look back at the biggest hurricanes and you can see that there have been some short-term impacts, but usually within days to weeks, these things have tended to normalize.
You come on quarterly, and we always enjoy the conversations. I'm going to ask you the quarterly question. In your opinion, what is the outlook for the oil markets over the next 3 months? Any predictions or anything that you're looking for in the data?
Oil markets tend to follow the economy. At least historically, that's been the case. And we're at an interesting juncture because sometimes all news is good news, and the phrase, right now, all news is bad news. So if the economy and jobs are doing well, financial markets are actually going down on that good news, right? And where that matters, and where the U.S. is different than much of the rest of the world, is that in our economy, where 70% of the economy is consumer spending by businesses and households, that means that how people feel about the economy really does matter to the pace at which they spend or whether they kind of hold things back. And the inverted yield curve of interest rates going down doesn't exactly make you want to behave in a rational manner for your investment or consumption at that point. So we've got some things to work through, and we need to see where that heads. If the economy stays on track, roughly as people expect, if it continues to accelerate over the latter half of this year, and if we're going toward record amounts for the global economy and a record amount for global oil demand this year, as we've already discussed, then that says that Texas does well, the U.S. does well. We just need to have policies that are stable enough environment and consistent enough to make it through. And it doesn't mean that things can't change along the way, meaning that if the Federal Reserve continues to respond as it has, as long as they're predictable about it, even if they overcorrect a little bit, we've seen unprecedented economic resilience. I don't think anybody really expected that if the Fed pushed the Fed's fund rate over 5%, that things would be as strong as they are. But yet here we are. And this tells you that $20 trillion wasn't wrong, right? That $20 trillion worth of global stimulus in the wake of the pandemic increased a lot of household savings along the way. It produced some resiliency where things were built up, and it's not all change versus level. We have to kind of keep the broader perspective of things may be marginally worse than they were from a household perspective as a result of these costs going up. There's a genuine distributional disparity between low and high income households and how people have fared through this. Different sizes of businesses also having different experiences. But in the aggregate, things have continued to hang together relatively solidly here. So I think the key actually is keeping the economy on track, with that making sure that you have predictable, affordable, abundant energy supplies to go with it. Not just oil and gas, by the way, but all energy, electricity, everything continuing to work together here. And if we have policies that incentivize it in an ad hoc way, just choosing technology winners and losers along the way. There's quite a debate right now about corporate average fuel economy standards and EPA's position. How do we make sure that things remain affordable and that markets continue to produce least cost solutions that are good for the environment, good for the economy, good for consumers at the end of the day?
We've had a very resilient economy. The markets have to decide. You can't let policy dictate of where a consumer is going to want to go, because the consumer is going to rebel and they're going to vote him out of office at the end of the day. You have to let the economy decide. And it's all forms of energy. It's not just oil and gas. It's not just electric. All forms of energy are going to help stimulate and grow this economy, because at some point we're going to have to stimulate it again. Dean, as always, this is insightful. And I always say it's absolutely fascinating. You're an economic genius when it comes to the oil markets, and I geek out on the oil market. So thank you so much, as always, for coming on. And as we look to wrap up this conversation until next quarter, what would you like our listeners to take away with them today?
I think just to have a broader perspective of staying the course here and realizing that the economy's quietly exceeded expectations. And there are uncertainties, but with Russia continuing to find ways to supply global markets, we see, if things remain on track, still some tightness there that needs to be watched. Gas markets are different. They're fundamentally different, though, and the loss of the Russian supplies has meant either Europe has to consume a lot less, or people have to creatively find ways to meet supply that are different than the way it's been done in the past. So again, unprecedented times for energy markets, interesting times for the economy. Just continue to geek out on these things, watch the data, and tune in at texoga.org, TXOGA.org. We're putting out a lot of this information. We have a new chart book on top of this. I get asked a lot about the data and the analytics of what are the things that you really need to watch. That's going to be updated weekly. We're continuing to put that out. We're 2 weeks into it. But these are things that I think are public, freely available resources that people can use both for their own interests and just staying apprised for their own investments and other behavior.
If you're interested in the oil markets, I highly recommend you check out the Texas Oil and Gas Association data. Dean does a wonderful job, and he's right. It can help you in your personal investments too, because you can learn a lot from the data in the oil and gas markets. The future is bright. The future is autonomous. The future is Texas Oil and Gas. Dean, thank you so much for coming on the Road to Autonomy today.
It's a pleasure. As always, I look forward to joining you each quarter. Thanks so much, Grayson. Great talking with you.
If you've enjoyed listening, please kindly rate, review, and subscribe on your favorite podcast platform. Want to get in touch? Follow us on Twitter, Instagram, and YouTube at Road to Autonomy, or email podcast@roadtoautonomy.com. The Road to Autonomy podcast is produced by the Road to Autonomy LLC. The views and opinions expressed in the Road to Autonomy podcast do not necessarily reflect those views of the Road to Autonomy, its subsidiaries, its shareholders, directors, investors, or partners. The content discussed on this podcast is for informational purposes only. and should not be taken as legal, investment, tax, or business advice. Nothing is a recommendation that you purchase, sell, or hold any security or other investment, or that you pursue any investment style or strategy. The content of this podcast is presented on an as-is basis with no warranties, express or implied, of any kind. Financial mentions about companies in the Road to Autonomy Index and discussions about the Road to Autonomy Indexes are for informational purposes only and should not be relied upon when making any investment decision. Furthermore, an inclusion of security within the Road to Autonomy Index is not a recommendation by the Road to Autonomy Indices, LLC, to buy, sell, or hold that such security, nor is it considered to be investment advice.